You're tuned in to the It's Real podcast with your hosts, Kayla, Kallander, and Andrew, Yaggie. Each week, we'll talk about what happens behind the scenes working full-time in real estate and share with you real-life stories, our successes and failures as we work to help consumers and industry professionals reach their real estate and real-life goals. Here we go.
Welcome to episode 33 of the It's Real podcast. I'm Kayla Kallander and I'm a mortgage lender.
And I'm Andrew Yaggie and I'm a real estate agent.
Hello, Andrew Yaggie. How are you today?
I'm great, Kayla Kallander. How are you?
I'm good. I always call you by your first and last name because that's how you are in everything that I have in my phone and everything. So I'm good though. I'm cold. I feel like I'm coming off of some sickness, which it sounds like you are too.
Yeah, same. I've got an awful head cold. It's been tough to catch a break this winter, it seems. And even just family and friends. And it seems like everybody has been really sick lately.
I know. And it's like, it goes from one thing to another. So, and if you've got kids, I feel like it's a whole other thing. It's like, you're sick again too. I don't have kids, but you know, when they're sick, you can't really do much. You got to really pivot. So have your kiddos been sick too?
They have. They're good now, but yeah, we've had kind of a string of sickness. But boy, I tell you, it even affects real estate. Just this last weekend, we had a number of different clients we were showing homes to, and most everybody canceled either because of the cold or illness. And I even have some sellers as well that are like, "Hey, we've got stuff going on. Just let's pull the house off the market just for a little bit here."
Yeah, and coming off the holidays too, and it's almost a reset. But hopefully, I see some warm temperatures coming. Maybe that will help kind of drive out some sickness and get people back in the game of real estate. So
right, that's my hope.
Yeah.
How are things going with you this week?
Good. It's been so busy, Andy. It's been, I feel like we're always busy, but this week I think I've had 13 or 14 meetings with clients, meaning new clients that are getting pre-qualified. We do a consult, or people getting into contract and we have a contract meeting. So it's been really busy, which is great. And people are getting serious. They're not just window shopping. They are ready to pull the trigger, especially with rates having come down just a little bit in the last couple of months. People are getting serious. And to that effect, maybe you see this too. People that maybe were approved in like 22 and decided not to buy, they're starting to come back out now. Like, hey, I think I'm ready. I think they're coming. We talked about this before. I think they're getting used to the fact that rates are not 2 or 3. They're, between 5 and 7, and they're ready to take that next step because they know it's not just about that rate.
Mm-hmm. For sure. Yeah, I'm seeing that too. I'm starting to see even, within our systems, people start to look at homes, a little bit more who have been disengaged for some time, and even people reaching out to us, quite a number of people reaching out, talking about selling. People are just, I think, are having a tough time, making heads or tails, of the market and the overall economy. I mean, look at what's going on with real estate. That's always the big question. What's going on with insurance? I mean, take a look at rates. Like, Kayla, I just got a letter the other day that, my main carrier for all of my personal rental properties, et cetera, is totally exiting the property and casualty market. So it's time to start shopping for insurance again. And I've even had, individuals looking to buy who, might want to sell where they're at right now, saying, hey, this just isn't feasible for us where we're at, or it doesn't fit us anymore. And boy, between insurance, taxes, et cetera, it's really challenging.
It is. And I think too, people are just, I had a call this week and the girl's like, I am just sick of renting. I have dogs, I have kids, I need a new home, and I'm willing to, sacrifice this or work more for this, because at the end of the day too, it's just about those things that you just can't replace with money. It's those things of those feelings that you get when you own a home or when you're ready to kind of expand. And we're in our home so much more since 2020. I think that before 2020, people were always in the office. They were going to the gym, they were going to a place with a sauna, where now people have these homes that fit everything. You can work from home. You have Instacart now. All of these things have made the impact on your home should be able to have it all. And, you probably see people cold plunging a lot, Andy, or have their sauna or their home gym. People really want a home that has it all. And we're seeing that shift for sure.
Mm-hmm. Yeah,
Mhm.
absolutely. I saw kind of an interesting article the other day, Kayla, when we talk about homes and, I think we had talked last time about the fact that, prior to COVID or in even decades ago, look at the 90s, people really favored large homes. And then it kind of started falling off a little bit. And then,
Yep.
COVID happens, people need to work from home, do more from home, like you're referencing. Um, and all of a sudden, larger homes are back in favor again. It's kind of funny you bring that up. I was just kind of browsing through some emails, and I kind of talked about the fact that empty nesters own twice as many big homes as millennials with kids. So baby
Mhm.
boomers own 28% of the large homes in the United States, twice as many as
Yes.
millennials with kids, which is really, really interesting to see. What do you
Mhm.
make?
I don't know what to think of that. I haven't seen that article and it surprises me because I feel like so many people are going to, say, hey, I want to, find a smaller home. We don't have as many kids. What do the articles say? What did you find? Was it any reason why?
Well, I think it goes back to those housing trends in years past. And, the article does talk about, well, traditional logic would say that there should be a flood of large homes hitting the market in the coming years, when the boomers
Yeah.
no longer need them. Um, they've kind of been disincentivized from selling their homes,
Yeah.
just because, the market may not be favorable. But I think the gist of it is, going forward and, maybe not immediately, but there are going to be a lot of larger homes hitting the market. And the question is there going to be a huge demand for these large homes? I was just sitting with kind of a good friend and someone that I've done quite a number of real estate transactions with. Just yesterday we were sitting and talking and just talking about the younger generations and even younger than us old soul millennials, Kayla,
Mhm.
how just nobody, it's just kind of such a throwaway society and generation where, even, some of the younger generations, are more apt to maybe use paper plates than have regular plates in the cupboard and just have different desires, different trends.
Right.
And I even look at my own family. My parents are looking at selling our childhood home, which is quite large, and
Mhm.
I've got siblings that live back there, and nobody exactly wants it.
Yeah.
Because of the function and size. So I think it could be challenging,
Mhm.
as some of the boomers start moving on.
Yeah, that's great points because I think it'll be interesting, I will say, with what comes in 24 because a lot of people too did not want to sell their homes because of lower interest rates. And as, rates come down and, their low rate, it kind of that gap evens or, gets smaller. I think we'll also see some more properties come out and inventory increase as well.
I think so. Speaking of rates, Kayla, what are rates doing this week?
So they're up a little bit this week. Not a huge shift, but thank you for showing this 6.89% on a 30-year traditional, great credit fixed. So still good. I locked someone in today on a 30-year fixed at 6.5. So it just kind of depends. North Dakota, we saw their rates decrease actually, which is exciting. So that's something too, where it's just because you see a 30-year fixed go up this week, it doesn't mean all programs are. It doesn't at all. And so, we are seeing. Thank you, Andy. See, last week I think it was 585 for that first line, and now it's 565. So, if you're a first time home buyer in the state of North Dakota and you make under, I think it's 66,000, I believe, for that first line, you can get in the fives. So that's why it's truly a customized approach. It's not, hey, what's my rate today? Can you run a payment on this? It's, well, let's talk about what programs you qualify for because 6.89 looks a lot different than 5.65 or 5.4. So we're seeing just a little bit of movement, but nothing too drastic.
Kayla, I've got a mortgage question. Out of all of the people that you work with, what percent of the home buyers out there, go for a 30-year mortgage over, a 15-year or 10 or something like that? I feel like
99.
I don't see many. The majority of what I see is 30-year.
Yeah. The thing is, I coached a client on this today, even about putting money down. your coach to put 20% down, do a 15-year. But at the end of the day, it has to be, a full financial picture, which I love when clients use financial advisors, because it's like today on my call, I told the client, I said, if you want to put 5% down, you can. You don't have to put 10% down. Your mortgage insurance is only $45 a month. Talk to your financial advisor, because that extra, that difference of 10 and 5%, maybe you could invest that. Maybe you can pay off some higher interest debt. And so to go back to your question, Andy, about a 30-year versus a 15-year, your payment's going to go up. Yes, your rate's going to come down. You saw rates are lower on a 15-year, but you are required to make that higher payment. Your cash flow is decreasing. Whereas a 30-year, you can make additional payments anytime. But truthfully, it comes down to talk to your financial advisor and say, hey, what can I do with these extra funds? Whether it's down payment or a 15 to a 30. But Andy, I would say in the last 3 years, I've maybe had one person that's a first-time buyer do a 15-year.
Sure.
Mm-hmm. Yeah.
I think a couple misnomers, especially in the mortgage world, the two biggest ones I see is that, hey, you do have to have 20% down and you want to avoid mortgage PMI, private mortgage insurance,
Mm-hmm.
like the plague, when realistically that it might not be such a bad thing.
No, and I've had clients that could probably pay cash for a home and they'll put 5% down because their mortgage insurance is so cheap. But the fact of the matter is they're using those funds to do other things. And that's where consumers need to be educated. They need to have the correct people on their team, a realtor, a financial advisor, a lender, an accountant, because what if you could take that other 5% and roll that into an investment property? And what if you could, like I said, invest with your financial advisor at a 8%, 12% rate, whatever could work for them. It's all about being strategic about your money and having the right people in your circle.
For sure.
Mm-hmm.
So, Kayla, I know we've talked this year, we've given our predictions that rates will fall, anywhere from 3 to 5 rate cuts from the Fed. And another article I saw just the other day talked about consumer sentiment. Consumers now more than ever, saying as well that rates will fall, which some people would say, well, that's stating the obvious based on economic data out there. But Kayla, what that tells me is that consumer sentiment is really, really strong, or it's favorable in that, hey, we think rates are going to fall. We are going out there and we're buying. We're in the game. We're in the market. So I think that's really, really great to see. That's going to be encouraging too for people that are selling and putting their homes on the market. And it also jives kind of with what you were saying, that, people are coming alive and not just window shopping. They're ready to go. What do you make of that?
I think there's a lot of discussion on social media platforms and the media that rates are going to drop. So I think it gets people really revved up and excited again. But I think it's important to remember that we don't know how much the rates are going to come down and when. And so I think that this creates some positive momentum forward, but also that, even if you get approved to buy a home, rates might be a quarter different in 2 months, might be a half. We don't know. But I feel like it's positive momentum forward. And the best thing that you can do as a seller or a buyer is to just be prepared. If you're ready to pull the trigger, make sure you're pre-qualified. If you're ready to sell, make sure that you've talked to a realtor or you've been working with someone who could, give you a CMA up front to kind of have an idea, because we don't know if this is a June thing or a December thing. That's kind of what my thoughts on it. How about you?
Well, I think you're right. I think all of your points are spot on. How, the thing I've been pondering is how much of a difference are rates to the majority of the people. I mean, again, we saw the market was really slow, last year because of rates, but I think, and I'll kind of answer it, or maybe it's a little bit of a rhetorical question, but I think it depends on the group that's buying, Kayla, because, citing another study that just came out that I was reading the other day, just talked about the fact that millennials, especially 65% of millennials out there, would still buy a home if rates were 10%, which, man, I mean, it felt like rates were getting up to 10%, Kayla. But
It did feel like that.
But obviously we weren't quite there. But I think that's really, really interesting. And I don't know, maybe talk is cheap because now rates are certainly falling. And so, I mean, maybe people are just saying it to say it, but this study does say that more than three in four millennial home buyers would consider accepting an interest rate higher than the national rate of 7%. 65% would take 10% or more. So maybe that just says that, hey, if the house fits, I'm going to move forward with it. And in the short term, yeah, I'm going to pay, but that sets me up to do a little something called refinancing. And Kayla, I've been having more conversations with people hinting or even, talking to other lenders that, hey, we're starting to see a little more refinance business. So Kayla, what does it mean to refinance?
I love that we're talking about this, and I'm glad we are, because people are getting bombarded. If you've had a mortgage with someone in the past or online, now you should refinance. And yes, lower rates mean you should, but my personal opinion is now is not the time, unless you locked in at 8.5 maybe. Even if you did lock in at 8.5, the thing with a refinance is this, Andy, is that it's essentially redoing your loan. So let's say you locked in at 7% on a 30-year fixed, and you bought your home. When you refinance, we are redoing the loan. We're redoing title. You might need an appraisal. We're going to have to go through the whole loan process again. And it's essentially taking your balance and redoing it over another 30-year, if that's what you had, or if that's what you want to be in, at a lower rate. But what people forget is that it can cost money, and it does cost money because we're redoing it. You know what I mean? We still have the fees. So something to keep in mind is that, if you're at 7% and you're looking to refinance to 6.5%, well, if we look at the math on this, and I'll do the math here, you might think, wow, 0.5%, that means I can save a ton of money. Well, if I'm using for example, a $350,000 loan amount, the difference between 0.5% is $116. That's great, right, Andy? If you can refinance, redo the loan. But if it's going to cost you, let's just say $3,000, everyone's going to be different. You really have to think, is it worth it? Because what if rates drop again? What if rates go to 6%? That's a percentage. And so one thing to keep in mind when you're refinancing is, when is that sweet spot? Does it make sense? And if you do refinance and rates drop again, you're going to have to go through that process of doing the loan over again and paying the cost. So now it could be the time, but as we just talked about, rates are expected to drop in 2024, and when. And so it's important to keep in mind, when does it make sense? Is it a full percent? Is it 0.5%? Is it 2%? And what are the costs? And there's a lot of talk about free refinance, no cost refinance. And I would caution the consumer to look closely at that, because a lot of times a no cost refinance means the lender is increasing the rate and covering the closing costs for you.
And that's what I was going to ask you about, Kayla, because I had someone come in my office and inquiring on that. And in fact, just a quick Google search, no cost refinance. I mean, there are, a ton of hits here. So, I mean, why do I have to pay fees if I can find a provider that does it for free, Kayla?
Well, it's all in perspective, because no cost means, so for example, Andy, if you have equity in your home, let's say, which you should at this point if you're refinancing, what you can do is you increase the loan amount to cover the closing costs. So if you have to bring in $3,000, let's increase the loan amount by $3,000. We'll cover it. No cost to you, technically. Same with a lender that increases the rate. Just like you can buy down the rate, pay points to get a lower rate, you can take a higher rate and get a credit. Guess what? No cost, you're getting a credit, but in turn, you're taking a higher rate. So there are things as no cost to you or free, but you're technically paying for it in some other way.
The old bait and switch.
And a lot of people don't realize that. Or they're saying, well, my lender says if I buy with them now, I get a free refinance later. I mean, really, it's not a free refinance. I mean, I wish that I could go get an oil change for free, and I wish I could, go get my hair done for free. But in reality, it's all about perspective. A lot of businesses are not just doing transactions for free.
No such thing as a free lunch.
No such thing as a free lunch. So,
Kayla, when I think of refinancing, it kind of makes my head hurt, kind of like as I'm thinking about having
Yeah.
to redo all of my insurance policies, that makes my head hurt. But it makes me think back to, when I jumped into real estate in 2020. Did I ever tell you the story? Do you remember me telling you about my refinance
Oh, I
story?
remember, but I want to hear it again.
Okay, so long story short, it was the refi boom because rates were, had fallen precipitously.
Yeah.
And we moved into our new house, so came to Fergus Falls in 2011, and moved up to a larger home, growing family. 2018, got in a 30-year mortgage at 4.625, I think. And so the time came, it's like, wow, rates have fallen, time to refi. So it was so busy. And I think, a little bit of inattentiveness on the part of my loan officer and kind of their back room. And then it was just busy. But my refi got pushed 4 or 5 times. In the meantime, I made a change in employment. And, it already, and things were supposed to be finalized, and, life got busy. It was stressful. And I forgot about, the refi piece because it was supposed to be done and whatever. It was kind of out of sight at the moment. Well, it didn't get done on time before I changed employment. And then I did, and they called to verify my employment. And lo and behold, they could not do the refi anymore, but they offered, and we were at, we were going to refi 15 years at about 2.7, 2.8 or whatever.
Right.
And, and the loan officer was not very kind to me, and showed me that there wasn't a relationship there, which was unfortunate. But it actually worked out for the best. Because we found another great loan officer to work with. And he said, hey, why don't you try to do it just with your wife's income, which we did. And we were able to do, which still disappoints me in that loan officer who's now retired and not in the business. But so why not suggest solutions or say, what can we do versus them offering to keep it in-house, for a longer term at a greater rate? Why not find solutions? But in the meantime, it worked out for the best because we got down to about 2.375, Kayla.
Dang.
And so it actually worked out really, really well in the end. But it was a very frustrating experience, which still I love sharing that story with people from the standpoint of it's so important who you work with and who you align yourself with. And just to go out and find someone who is going to be there, who wants to have a relationship with you, because it's pretty evident most people are so transactional out there. They don't care about the relationship.
No, and that's so true, and that's so important. And I'm glad you say that too, because what if that wouldn't have worked out? I mean, that's a lot of money that your family would have given up. And the thing is that's where I'm so big on, and this, Andy, because I talked to you about it, is when you're told by your realtor or your financial advisor as a consumer, go shop around, go shop rates. That is the worst advice you can ever give your client. I'm sorry, I'm saying it. I've never said this out loud, but this is on the internet for everyone to see. That is the worst darn advice. And it makes me angry, because what the person should be saying is go shop around to get to know your lender, to discuss rates and programs and options. Make sure that you're speaking with someone that's accessible, and are they empathizing with you, and are they educating you? Because now more than ever, people are craving education and empathy because there's so much noise. So if you're a realtor or a financial advisor or a CPA or a friend, if you're saying go shop rates, stop saying that. Say yes, include that, but it's one piece of the 10 things you should be looking for.
Absolutely. I think the biggest problem, though, Kayla, is that the consumer comes out and they don't know what to ask. They don't know. They're not knowledgeable about it, and so it's well intentioned, but you're right. It isn't helpful because I know nothing else. I know I can compare rating costs, but because I don't know what else to ask about. So really it's on, and that's why I love the opportunity, to get to sit down and visit with people and say, hey, I know you're sitting out there and you think every agent does the same thing. And hey, what's your percent? What's your percent? What are you charging? But well, let's just slow down and let's just talk about how we're different. And let me show you some of the things that I'm doing that no other agent is really doing. And then if it's a fit for you, then, we'll talk about, the services we provide and the charges. But let's talk about what makes us different and what we're going to do for you as a client.
And you're spot on, Andy. That's all they really know. And it's like people don't go around shopping, realtors based on, their fee. It's what can we do for you? You get what you pay for. And it's not just about who's the cheapest, because you'll always find someone who's cheaper. But that's what I love about you is you also have those consults. You sit down with your people, you get to know them. And if your realtor or lender is just sending you, here, let's get you in contract, or here's a link to apply. It's more than that. If you really want the white glove service, you've got to take the time to sit down and have conversations.
Absolutely. Kayla, if someone's interested in refinancing, they're not sure, if now's a good time for them, what's your best piece of advice?
My best piece of advice is to, watch the market, keep your pulse on that. But, contact a lender who's going to look at your full scenario. Make sure that you have some type of breakdown. Like, what's my break-even point if I refinance? What's my actual cost? And what does my loan amount look like? Are they increasing the loan amount? Find that out. Find out what an estimated rate is. And just have conversations. And then that can kind of give you an idea of, okay, I think we're going to wait until it at least hits, 6. That makes sense. But truly keep your pulse on it, or work with a lender. If you worked with a lender before, they should be reaching out to let you know too. But I'd also be cautious because it might not make sense to refinance now if rates do come down.
Absolutely. And Kayla, just maybe a final question. How long does it take? Because I know some people say, oh, this is going to take a lot of time. It's a lot of paperwork, a lot of headache. How long does it take?
Well, traditionally, it depends on the client. How quickly are they going to get us the docs? And how quickly are they going to lock in a rate? And how quickly are they going to choose insurance? But essentially, 30 days. I mean, if title's done, if we need an appraisal, sometimes it depends on where that's located. Colorado appraisals are a lot quicker than North Dakota appraisals. So it just depends, but I would anticipate 30 days, 40 days, as long as you get everything in and we can get an appraisal and title done.
Awesome.
Yeah, great questions, Andy. So if you need to refinance, now you know.
I know. Now I know where I'm coming next time. I need to refi. Although I think if we stick in this house, I don't think we will be.
Yeah, I hear you. I know what you mean. I hear you. But
well, Kayla, it's a pleasure as always to visit. Thanks for chatting refi and everything real estate and mortgage under the sun. I hope you have a great rest of the week and stay warm.
I will if you will.
We'll see you.
Bye, Andy.